Hey everyone. Well, it's a fresh look for me with a different background as I'm shooting this video while I'm on the road this week. And so I did want to get some fresh information out there for all of you about what's going on in the economy. There have been a lot of changes in the last week with President Trump adopting 25% tariffs on Canada and Mexico while doubling the tariffs on China to 20%. Now remember, those three countries are our biggest trade partners. They represent 41.5% of the total US imports. Now, this could create some challenges, including elevated inflation potentially. It could also slow the economic growth, and we're already hearing from the Atlanta Federal Reserve Bank that there are risks to first quarter GDP growth. They updated their numbers to a net loss of 2.8% in the first quarter. Now that's a modeled number, and they've already said, hey, we haven't really looked into this. This is just what the computer punched out. But nonetheless, there are some risks out there. Now, I don't really actually want to talk about the tariffs per se, because those could be removed at any given day. In fact, they may be removed sometime between when I'm recording this and when you see it, or in the week after or something like that. So the challenge here is actually the uncertainty that comes with these policies. Basically, the uncertainty index has shot to the second highest level in history, right behind the pandemic. It's higher than the global financial crisis. It's higher than the last time we had a government shutdown. And that uncertainty creates a variety of challenges, including indecisiveness by businesses and decision makers, but it also creates a lot of volatility in the financial markets. We've seen the VIX escalate very quickly. It jumped up last week as the stock market fell, and then it had a partial correction and it improved, and we've seen it moving around a lot. And together with that, you have that uncertainty index that shot skyward. So we have these functions out there that are a byproduct of these policies and the uncertainty that goes with it. Now, as we go forward, there are positive aspects to that. That uncertainty, that volatility in the financial markets often causes investors to move to more secure assets. They may shift from investing in the stock market into hard assets like gold, like real estate. In fact, the other byproduct of these tariffs, the inflation, also causes a migration of capital into hard assets. And the risk of a potential recession also encourages investors to move their capital into hard assets. So while we have a lot of uncertainty, while we have a lot of volatility, while we have risks of increased inflation and we have risks that our economic growth could weaken, these are all indicators that investors may start shifting their assets and their investments over into hard assets, and that could shift the paradigm a little bit on the allocations going into real estate. So when we see all these headlines and it makes a lot of noise, we have to remember that there are different parts to the story, and that the movements may be going one direction for one part of the economy, but cause a reaction in another area of the economy or in the businesses that are associated with it. And that could result in some increased momentum for transaction velocity, potentially. I'm not saying that it will, but this is classically one of the ways people hedge their investments and their risk by going into these types of assets. So there's a lot of uncertainty right now. I don't think that's going to abate. I think the inflationary risks are rising. I think that there are some challenges ahead, but that doesn't mean it's bad for real estate, and investors really need to pay attention to the trends that are happening out there today. We saw interest rates drop briefly as there was a flight to safety. That can be a positive for real estate investors as well. So as always, I want to remind you to keep your eyes on the horizon.